So if you have 100 shares of a stock, you should probably watch this video. And if you have 100 shares of a lot of stocks, you might not need to be going to work anymore. In this video, I'm going to give you the simplest explanation of the covered call, which is an option strategy to earn extra income. And I know a lot of people hear the word options and they run for the hills. That's fine. You could be one of those people that turns your back, or you could be one of those people with an open mind, listens to what I have to say, and then you can continue to earn money like we've been doing for years on this channel and inside the Discord. And as I mentioned to the Discord the other day, next year, 2025, is going to be the year where I think that I can earn enough money from selling covered calls to offset my entire income from my W-2 job and possibly retire at the end of the year and continue to do this full time. And like I said, before you call BS on that, just listen to what I have to say. I'm going to explain, even if you've never heard of an option or know what's going on, I'm going to give you the simplest explanation. Let's dive into the whiteboard and I'll tell you exactly what a covered call is and how you can really start to execute one today if you have 100 shares of any stock. Okay, first let's start with something that we probably all know. And that one thing we all know is one share of a company. And that one share of a company has a value. We call that the share price. Okay, so I need to start really simple here so we can compare everything. And we know on the stock market, the share price can go up or it can go down. And if we own that share and the share price goes up, we make money. If the price goes down, we lose money. Now, here's where options come into play. If you are able to collect 100 shares of a company, now we can bundle those 100 shares, not into one share, but one options contract. So that's the first thing we need to remember, is that an options contract is always 100 shares. So that's why I said in the beginning of this video, we have to have 100 shares of a quality company. Guys, don't do this with BS companies. Do this with quality companies, because at the end of the day, it is in fact an investment. Now, just like a share price has a value, an options contract also has a value, but that value we call the premium. And that premium is often shown by a dollar amount. For example, $2.20. But now, because we have 100 shares of this contract, we have to remember that this is really going to be for us $220, not $2.20. $2.20 times 100. These are going to be the values of the contracts that we are going to be looking at. And once again, that is called the premium of this options contract. And just like I can sell and buy shares, I can sell and buy options contracts. And when you hear about the dangers of options, oftentimes that comes with buying options contracts. You need to have a lot of things go right. And there's a lot more risk in buying options contracts than selling. This video is just about selling options with the 100 shares that we have. So now that we know the difference between buying and selling a share, now we're going to be buying and selling options contracts. Here's a little bit more vocabulary that we need to know right from the jump besides just premium, okay? So premium is going to be the money that we are going to collect. That's going to be the value of the contract when we sell that option. We are selling calls, we are not buying, all right? So we have the premium. The next thing what we're going to look for is something called the strike price. Now the strike price is going to be a price that we choose for this options contract that we'd be willing to sell away our 100 shares. So this is going to be a very important value. And this is why selling options is way safer, in my opinion, with less risk than buying, because we get to choose the price that we would happen to sell our shares if this option did not go our way. So with that strike price, another thing we are going to choose is expiration. Now, your expiration date is usually going to be every single week, depending on the share. And this is also going to be up to you to choose, but it's really going to be personal preference. It's not really going to make that much of a difference. There is a little bit of nuance as you become more experienced, but these are the parts of this options contract: the value of that option, the strike price at which we want to activate that option, and the expiration when we want things to end for that options contract. And the last word that I'm going to use or phrase is something called the cost basis. Okay, now the cost basis is the average price you paid for your 100 shares. So at the end of the day, after you've been building shares up, maybe you didn't buy them all at the same time. Let's say you have 100 shares at an average cost of $91.26. This value right here is going to be the cost basis, and it is very, very important for you to know when you are selling options. This cost basis right here is the thing that is going to protect you from winning or losing with this option. And as long as you stay disciplined, I've said many times, you cannot, this is a win-win scenario. All right, this is a win-win scenario if you stay disciplined and you follow very, very simple rules. We lose money when we tend to get greedy and we don't follow the rules. I'm a rule follower, big rule follower. So that's why I will be able to say with confidence that this is a win-win strategy. And I am going to jump inside an options chain and show you where all of this is, and you'll see exactly what I'm talking about. One last thing, guys. Everyone talks about the Greeks. You will hear about the Greeks. I have an amazing video on the Greeks, probably one of the most viewed videos on this channel. But the only Greek I'm really going to care about, which after you get some experience, you won't care about, is something called delta. And this is just a way for us to evaluate how much risk we are taking on when we sell this options contract. So let's pull up a hypothetical situation here, and then I'll show you it in real time. I just said I have 100 shares of stock XYZ, and my cost basis is $91.26. This is the amount of money that I paid for those 100 shares on average, okay? And I've decided that I now want to sell a call option. This is called a covered call. And let's just say today is a Monday, which only matters because I'm going to say I want this expiration date to be on Friday. So I'm going to choose a date that is next Friday, and I'm going to write that option. If I want it for 2 weeks, I'll make it for 2 weeks. Like I said, you get to choose, and you'll see why you might want a Monday to a Friday versus a Monday to a month from now. But just to keep our vocabulary straight, I'm going to choose my expiration for next Friday. Now, also, I see that the current share price, what this stock XYZ is selling for today, it's selling for $95.26 as we enter the day. So this is the current share price. So I am already up on these shares. I've made about $400 in capital gains owning these shares. Once I have all of this information here, that is all I need to know to write my covered call. When I say write, that means sell. In options term, when I say write, it means to sell. That's it. So the next thing I have to do is I have to choose my strike price. And this is where that cost basis is really going to be important. And you have two options with this option. See what I did there? Two options. Let's go the beginner option first. The first route, okay? The first thing you would do is you would choose a strike with a delta equal to 0.2 or less. All right, and I will show you where you can see that delta inside most options chains, even something as basic as Robinhood, which I will show up. What this means is that you have roughly an 80% chance of this price not hitting your strike price, which is what we want. We do not want the share price to hit our strike price. We want it to stay below our share price for a covered call. So we think about this as a percentage for the buyer to win, right? Because they are going to be the ones buying our contracts, right? This 20% means they have a 20% chance of winning. So that means we have an 80%. So when you're new to this, you can choose a very, very small delta just to get a feel for things and get an understanding of how this works at a pretty low risk. Now, once you get some more experience and you understand things and you know how to close them, and I will tell you how we're going to close these things or what our options are once we have them open, you can look at the second way that you choose your strike price, and this is how I currently choose my strike price. I choose a strike price that is one options contract above the current share price as long as it is above my cost basis. The only rule to protect yourself from losing money in a covered call is that your strike price must be above your cost basis. If the share price and the strike price is above your cost basis and these options get called away at expiration, you are going to get the cash for that strike price and make capital gains, okay? If you write your strike price below your cost basis and you are forced to sell away your 100 shares at expiration, you will lose money because you're selling them for less money than you bought them. Very, very simple to understand. So usually they go by a dollar. So I would probably choose a strike price of $96 expiring on Friday. And when I look to the side of that strike price, I am going to see that this has a premium or a value of $2.20. That means that when I sell this contract and it is filled by a buyer, I am now going to own a contract and I just made $220. And regardless of the outcome of this option, I keep this money. It's mine, right? So if I could do this, I'm going to make $220 per week. If I have 200 shares, 440. If I have 300 shares, you get the idea. And that's how I plan, because right now I have almost 800 shares of some stocks and I'm selling multiple contracts, collecting a lot of premium. Now, does that take a lot of money to get those 100 shares? Yes, but I've been doing this for 7 years. And if you start now, you start building up and you get 100 shares of one, then you get 100 shares of another, and it just snowballs. And you go from making a couple $100 to a couple $1,000 to almost a livable wage by doing this simple strategy. So now that we own that contract, let's talk about how we're going to manage it and possibly close it. I do not want to go to expiration. I'm going to tell you how you can avoid that. So let's say right now it's Tuesday, okay? And the share price now is starting to creep up and it's worth $95.75, all right? It is getting pretty close to our $96 strike price. During that time where this actual current share price of the shares is fluctuating, so is the price or the value of that option. So when I close the option, the value is worth $2.20. Now as it's gone up, let's say that value now has increased because it's going to be closer to our strike price, and now it's worth $2.85. This is a situation where we don't really care as long as it's below 96. As long as it's below 96, that is awesome for us. If the share price was to go down on Tuesday to $95, the value of that option is going to go down with it. And let's say now it's worth $165. And this is going to happen throughout the week. The share price is going to go up. The value of the options is going to go up and down as well. As long as it's below that threshold of $96, we are good to go. And we have a couple different options as the week goes by. Let's say maybe this thing really, really tanks down and it goes down to like $93. And the value of the option is now worth, say, 75 cents or roughly $75. Remember, we bought it for $2.20. So anytime before expiration, I can attempt to buy that option back at a smaller price. So if I sold and I collected $220, and now I see that I can close that option by buying the same exact one back to myself. If I buy it for a negative $75, now I am going to net the difference of that option of $145. So instead of the original $220 I collected, I sold it for $220. And then I bought the same one to close it for $75, and this will be the net. This is how most people treat calls. They hope that as the week goes by, the value of the option goes down, all the way down, 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 and then we can buy it back for a cheaper amount, close it out, and just keep the difference. If we never bought to close and it stayed below, this would tumble all the way to Friday. And at Friday's expiration date, if it's below 96, the value of that option is going to be zero. We'll say that's worthless now, and we would keep the entire $220. So once we're open, we have a couple different options. We can let it chill until expiration and hope that it expires worthless, meaning it stays below 96. Or we can buy to close this option at a lower current value than what we sold it for to net the difference of premium and then repeat. And the last option that we have is if things don't go well, Let's say it's Wednesday now and the share price, it has climbed to $96.50. Well, now this option is now in the money. It is above our strike price. And if it stays like this until expiration, what's going to happen is the buyer of the option is going to get all of our shares for $96, even though they're worth $96.50. So we're going to be selling shares for less money than they're currently worth. You do not have to accept that deal. What we can do is we can roll the option. So what we're going to do is we are going to buy to close, and then we are going to open, then we're going to sell to open a brand new contract further out in expiration, giving us some time for things to go our way. At the end of this video, I will link a video to how to close options so that you can get a more detailed look on that exact process. But let's dive into my broker over in Robinhood and see exactly what this looks like in real time inside the brokerage. Now, it's worth noting that options contracts do not sell over the weekend or not during market hours. It is the weekend, so the prices and premiums may be a little wacky, but you'll get an idea of what I'm saying. So you can see here are some stocks that I am wheeling with. Apple, Amazon, Google, VTI, a ton of money. You can see it's only worth 53, guys. I'm using margin here, so that's how that is different. I have 200 shares of VTI, which I just started, which is kind of what stemmed this conversation inside the Discord. I will leave a link to the Discord if you want to jump in there and hop in with like-minded individuals and see exactly what we're doing in real time. But if I were to click one of these stocks that I have 100 shares, and you can see I have a sell call, sell call, sell call, sell call. I have sell calls and then this Tesla put that I got smoked on. If I were to open this up, somewhere in your brokerage, you're going to see like options chain or trade options. Over here, it says trade options. I'm going to click trade options on here. And then what we are going to do is make sure that we are sell and we are call. And here's the expiration where I can choose all the expirations out as far as I want. I'm going to scroll down to the lowest share price here. But remember, I need to understand what my cost basis is. So if I go back and look at my actual shares, somewhere in your holdings, it is going to tell you your average cost. Mine, $294.50. So I would have to make sure that my strike price is above $294.50, and I would not lose on this options contract. So I'll go back in. I'm 6 days away. I want to sell, call. Right now you can see I have 2 of them open. All right. And that is above my share price of $295. If I want a little bit more detail, maybe on that delta, because I'm curious, like, oh, maybe I'm new to this, I want to make sure my delta is 0.2. I would go down and here is the delta value of 0.67. And if I click some more, you'll see the further away from the share price, 0.45, 0.22, 0.08. So you might choose something down here that is going to have a smaller delta when you're first starting out. For me, I'm perfectly happy with what I have. And over here is going to be the value of this option, $295 I will collect for owning just those 100 shares. If I want to go a little above the share price, $143. The further I go away from the current share price, the smaller my premium, but the lower the risk that my shares will be called away. So that's why I said some people get greedy and they're like, oh, I can sell this one for $700. It can be called away immediately for $290 when the share price is $296. That doesn't really sound like a very, very good deal. Once I click this option, it'll come over here. It'll tell me in Robinhood that I have a covered call. It'll explain some max loss and some max profits and things like that. And then we will click continue. You will put in the value that you want. You can choose bid and ask price, closer to the bid, closer to the ask. I have a couple videos to show you how to get your contracts filled a little bit quicker. Boom. I would get an average credit of $294 and some fees that they take away, 3 cents in fees. And that would be that. And I could collect the money. I'll do update videos on this from time to time, guys, and show you exactly what I'm doing. Like I said, I will leave a video on how to close options and really the difference between selling a call and buying a call. If you want all this information in a handheld version, guys, I do have a book on selling and calling options. You can find all of this for free, but this is also on Amazon. It's pretty affordable. I'll leave a link to that if you want to hold that and support the channel. I'll catch you guys on the next video.